I like to say it's a hurricane over real estate right now. We're in the Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do over the longer term.
As you just heard, storm clouds of epic proportions are forming just over the housing market. The expert himself has rung the bells, and we all must take heed. Now, before you cuss out on who this expert thinks he is, guys, it's Barry Sternlicht we're talking about. The billionaire and co-founder and CEO of Starwood Capital Group, an investment beast with over $120 billion in assets. Yeah, that Barry Sternlicht. As a true big-game player in the world of real estate, his vantage point gives him a pure, behind-the-scenes look at the inner workings of the real estate market, something only seasons of experience can offer. And that's precisely why we were intrigued by a recent interview he made with Bloomberg, where he dropped this bombshell.
Let's talk about your other business, which is the non-lodging business. So you are one of the best known and one of the best real estate investors in our country. Right now, many people think the real estate market is going to be in trouble because high interest rates are making it more and more difficult for people to service their loans, and we're going to have a lot of defaults soon. What do you think about that observation?
Anything with a fixed income stream is worth less when rates rise. And the underlying fundamentals in most of the asset classes in real estate are okay right now in the United States. The apartment market, the industrial logistics market, the hotel markets, those are all in good shape. But there's no question that the Fed has reacted dramatically to try to slow the economy down quite late, obviously. And that has impacted real estate values. Yields on properties are moving up to reflect this higher interest rate, and the supply of credit to the industry is curtailed dramatically. So I like to say it's a hurricane over real estate right now. We're in the Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do over the longer term.
At first glance, we admit it sounds a bit overdramatic, but the bigger picture is quite the marvel. Before we begin though, how familiar are you with the relationship between real estate values and interest rates? You see, real estate has fixed income streams, which by definition is a predictable amount of cash that it generates year in and year out. Say you happen to be the proud owner of an elegant building that is being occupied by a tenant on a solid 5-year lease. Here's the beautiful part. You would already have a crystal clear picture of what your rental income will look like for the duration. $500,000 every year? It would be easy to calculate what your income would be. Why? Because it's fixed. The locked-in cash flows are as dependable as time ticking by. With that in mind, let's dissect what Sternlicht means when he said assets with fixed income streams decline in value when interest rates soar by considering a different scenario. Meet Sarah, a beautiful, seasoned real estate investor in New York City, the buzzing metropolis that never sleeps. Say she has a beautiful office downtown that ideally generates around $120,000 in annual rental income. That being said, she is an optimist. She expects the rental income to grow at a steady rate of 4% every year for the next 5 years. Assuming the property is purchased on cash and not on a loan, the formula to calculate what her office building could be sold for at the end of 5 years is relatively easy. All she would need to determine the value of her property is to take out the cash the office generates and then divide that figure by the cap rate. Heard about that? Cap rate or capitalization rate is the assessment of the yield of a property over a year. It is the formula used to estimate an investor's potential return on a property. They usually have an inverse relationship to the property value. Moving on, Sarah has big plans. Considering a cap rate of 5.5%, she intends to sell her office building after 5 years and pocket the profits as a reward. But first, she must figure out what her property is worth today. Have you been paying attention? If yes, how would she determine the office's worth? Here's a hint: the time value of money would surely come into play. Knowing she can't take the future income from her building and assume it's the current value, Sarah would have to consider a discount rate, which in her case is 6%. And by crunching the numbers, she deduces that her office building is roughly worth $2.12 million. Of course, she gets excited, and who wouldn't? The investment appreciated nicely. However, the real estate market, especially when it comes to interest rates, can be quite volatile. Taking that into consideration, she decides to run another scenario with a higher discount rate, let's say 7%. With that rate, would all possibilities be equal? Certainly not. Here, the present value of her office building dropped to $1.95 million. That may sound nice on paper, but is it? The difference of approximately $170,000 is simply staggering. Are you starting to see why interest rates matter so much when it comes to real estate? In a nutshell, increasing a cap rate can drastically reduce the amount of money the property can be sold for in years. And as if that wasn't enough, the recession makes things a whole lot worse.
Your view is because of the kind of things you see coming, we will go into a recession in the United States, in your view?
Yeah.
And any way to avoid it at this point, or not really?
It's interesting. One of my friends had a meeting with one of the governors recently, last week. And they're like, we hear all this noise about the real estate, but we don't see the issues. They're going to come, and there is going to be a serious credit contraction. The country, in any asset class, has not adjusted to that cost of capital yet. But it's coming. The economy will slow. You can see the numbers. CO confidence is down, consumer confidence is down, retail sales are down, service economy is wickedly strong. It feels like the last gasp before we actually settle into what should be what you'd expect to be. I hope it's a shallow recession. I hope he can pull that off.
Normally, when you increase interest rates, you decrease GDP growth and you increase unemployment. Your point is unemployment's not going up because the statistics aren't really covering the people who are really being laid off?
Unemployment isn't going up because structurally interest rates aren't affecting the labor market the way they would normally affect the labor market. You have the offset in construction from the infrastructure bill, and you have the service sector, which is still recovering the pandemic, which normally would be tilting over.
To make things worse, the age-old pillar of basic economics, supply and demand, still comes into play. You see, real estate, much like what economists label as a commodity, hinges on a fundamental principle, that its price is intertwined to the ever-changing chain of supply and demand. Let's revisit our earlier example of Sarah's office building, shall we? So, we know the value of the building is dependent on the cash it generates, right? Good. Now, here's where things get dicey. What if we told you that what Sarah could charge per unit is directly influenced by the ebb and flow of supply and demand within her market? In the past few years, did you know that demand outstripped supply? When the economy was booming, everything was smooth as silk. Unemployment was low, and government stimulus programs were admirably high. But here is where the plot thickens. Then, home prices skyrocketed, leaving many potential homebuyers with no choice but to remain renters, thus increasing the demand for apartments. Now, while this significantly boosted the demand for these units, pushing them higher and higher, the prices of rent soared and generated an increase in cash flow for apartment buildings, making them more valuable. It's like clockwork. When demand increases, so would the valuation. Nevertheless, it can be a double-edged sword. In a recession, the demand for apartments tends to decline. When people get laid off from work, their primary source of income gets taken away, and sadly, could force them to review their expenses and cut costs. These cuts often force people to move back in with family or seek roommates with whom they can share rent expenses. Even worse, some existing tenants may face financial hardships, leading to evictions. And don't think for a second that homeowners love evictions. You see, not only does it strain apartment owners, but it also reduces the cash they generate, causing a drastic fall in demand. Office buildings in particular face an uncertain future. Guys, more and more companies are starting to embrace the concept of remote work. Believe it or not, with that approach, they are starting to realize that it can cut down on occupancy expenses while boosting employee happiness simultaneously. To put things in perspective, would you believe the top-tier Class A office buildings in California face a jaw-dropping 38% vacancy rate? What's even more concerning is the fact that if these leases expiring within the next 2 years fail to be renewed, the building's vacancy rate could soar to nearly 2/3 of its total space. It's worth mentioning that these stats in the metropolitan area of Southern California for a Class A building are unprecedented, especially before the era of COVID. Of course, a man as seasoned as Sternlicht understands what's at stake. He knows the era of remote jobs can cripple the market.
Well, the work from home phenomenon is a U.S. phenomenon. If you go to England or Germany, and we have some investments offshore, and I was just looking at rents are up and vacancy rates in the top German property markets, Berlin, Frankfurt, Munich, Hamburg, are less than 5%. People are back in the office. You and I go to the Middle East, they're full. We have offices in Asia, they're full. So this is a US situation. In the US, you have two markets. You have the really nice buildings that are ESG compliant, that are lovely, like the one we're sitting in. This place is buzzing, and they're back because it's a fun place to be. And if you're in a building with lots of cubicles and it's dark and there's no life and love, so nice buildings, even in a city as currently destitute as San Francisco from an office market perspective, the best buildings are still leased. And so you're going to see a bifurcation of the market in office. The nice buildings will stay rented, and my guess is at pretty good rates. And the B and C stuff is going to be maybe fields of grain or something. It'll be very pretty. We'll have all these little mid-block parks in New York City because there won't be anything else to do with those buildings. And nobody will carry them because there's no hope. Some of the cities that have issues on commuting, like New York or LA downtown, San Francisco, the CBD, that are difficult to commute to, that's where the pressure's so hard from workers saying, I don't want to drive into the city an hour and a half and drive home an hour and a half every day. But I also think a nice little recession will clear this, and you'll see people come back to the office. And I was in your town, take the Amazon HQ2, they're expecting people in those offices 4 days a week come the fall. So the other thing about office, David, is AI. AI is going to hit a couple of these industries that have been big users of office space.
Let's be frank, guys. Most office workers are no longer keen on practicing the traditional 5-day-a-week office grind. Rather than that, they'd prefer to either work from the comfort of their home or at least in a hybrid fashion. And this behavioral pattern would surely have a massive impact on the office market. Allow us to illustrate with a story. Let's imagine Dimitri, a young but super talented marketing guru. Before the pandemic, Dimitri woke up early in the morning, prepped himself for a long day at work, and spent what felt like never-ending hours in the office in the heart of a booming city. But then, in a flash, everything changed. Working from home suddenly became a thing. As soon as he partook in it, he began to find himself able to simultaneously work while enjoying breakfast in his pajamas. Or hey, having smooth transitions from work to immediately logging on to the PlayStation Network, instantly skipping the stressful rush hour traffic. Hey, he could even work out during lunch breaks. Here's a question for you. Say you were Dimitri and enjoying that flexibility that comes with having a remote setup. Would you really want your old work life back? Admit it, we are all Dimitri. That being said, let us fast forward to the bigger picture. Many office buildings that were once buzzing with activity now face a grim reality, a future with no occupants. It's already happening. Apart from our earlier example in California, similar stats are also happening in San Francisco. As things stand, vacancy rates are hovering around 30%. Imagine nearly a third of all office space in the entire city sitting empty. This is the reality the office market is currently facing. Nevertheless, it is worth mentioning that not all office buildings are being impacted. Criteria such as a building's age, quality, location, and amenities place office space into 3 distinct categories: Class A, B, or C. A is being the best the area can offer, and C being, well, the brunt of the bunch. Naturally, the companies, who still insist their workers work in an office, understand the importance of providing them with a pleasant working environment and would go for the best, keeping the demand for that niche high. However, the real problems in the office market heavily fall within the Class C office buildings. The truth is, these structures are either built in less desirable locations, suffer from outdated facilities, or both. The outlook for office structures in this class is so bleak that, in many instances, it would be more cost-effective for owners to tear down the whole building than maintain it. Now, shifting gears to another area of concern in the real estate market, we have single-family houses.
Do you see a recession there because prices are going to come down at some point, or you don't see a recession in housing?
I think the housing market's had a very unusual situation where Powell's increase in rates has diminished supply. And people, I'm not sure we've ever had a situation where so many people have locked in their mortgage costs. So right now, people are sticking in their house, which has diminished the supply of homes for sale. I wonder when rates come down, homes will be sold, like people will start, because the mortgage will no longer be a reason to hold on to the house. And whether that will offset will probably be an increase in supply as the builders resume a more normal cycle. So maybe the housing market just stagnates for a while, but over time it's headed up.
In recent weeks, U.S. home prices have surged to astronomical levels, with the 30-year fixed mortgage rate reaching a crazy 22-year high of 7.23%. Unavoidably, this has worsened an already concerning affordability situation. Currently, purchasing a medium-priced home with a 20% down payment would necessitate a monthly principal and interest payment of $2,440, a stark increase of $1,172 compared to just 2 years ago. As crazy as that sounds, this represents an eye-popping 92% increase in mortgage payments, further crippling the household market that was already struggling with inflation. As things stand, a daunting 38.6% of the median household income is required to cover the monthly payment on an average home purchase, marking the lowest affordability levels since 1984. To make things worse, bringing housing affordability back to its 25-year average would require a combination of factors, such as a significant home price decline, a substantial reduction in mortgage rates, or a substantial growth in median household incomes. How long could it possibly take for all that to happen? In case you were wondering why home affordability is so low at the moment, we can't help but think it's due to these two main reasons. For one, the cost of home prices in America has skyrocketed. However, this is just one part of the equation. Another big factor likely driving home ownership to unattainable levels for the average American is the recent uptick in interest rates. At the beginning of 2021, the average interest rate for a standard 30-year fixed-rate mortgage was as low as 2.65%. Since then, it has soared to as high as 7%. This dramatic rise in interest rates has significantly increased the cost of purchasing a home through a mortgage, adding more layers to the affordability challenge in the housing market. Let's consider a $300,000 15-year mortgage with a 4% interest rate. The monthly payment for this mortgage would be approximately $2,219, right? Well, think about this. If we increase the interest rate to 6% while keeping the loan amount and term the same, the monthly payment jumps to approximately $2,760. This higher interest rate leads to a 25% increase in the monthly payment despite the loan amount remaining unchanged. Now, you're probably wondering if these higher interest rates would significantly drop home prices, aren't you? If so, prepare to have your minds blown, as it is not that straightforward. You see, those who bought houses during the era of low interest rates find themselves in a tricky situation. They're hesitant to put their current property up for sale because selling it would mean giving up those lower interest rates. This dilemma is artificially limiting the supply of homes available for sale. Amidst the chaos, we are super thrilled to see what the future of the real estate market would end up as. While Sternlicht believes that the next 12 to 18 months will be an uphill drive for many, he did say survive till 2025, a silver lining that we have to consider. If we go through the storm head on, we are bound to enter its eye. Who knows what exciting opportunities await us on the other side of this Category 5 hurricane?